March 28, 2024, the Public Company Accounting Oversight Board drops a document that sends a quiet tremor through the financial world. $2.75 million, a penalty leveled against PricewaterhouseCoopers, one of the most powerful audit firms on earth. Not for fraud, not for a cover-up, but for something regulators consider equally corrosive: a fundamental failure of auditor independence. PwC US was simultaneously auditing a software issuer and doing business with them. Revenue from that business relationship was projected to eclipse the audit fees entirely. Inside PwC's tax group, a business case was quietly being built. Numbers on a spreadsheet telling a story the Independence Office was never meant to see. In November 2018, two PwC partners, including the very partner leading the active audit, sat down with the software issuer's CEO and president. A meeting arranged at the direction of a national assurance leader. The agenda: tens of millions of dollars in joint business opportunities. The problem? An audit was still open, and nobody called the Independence Office. The consultation that should have happened before that meeting, before any of this, only happened after regulators came knocking, and what they found shook the foundation of auditor trust. PricewaterhouseCoopers, one of 4 firms that hold the accounting world in the palms of their hands, a name that carries the weight of institutional trust across every major financial market on the planet. Their business is a simple promise that when they sign off on a company's financial statements, those numbers can be trusted, that investors, regulators, and markets can act on those numbers with confidence. But that promise has one absolute prerequisite: independence. An auditor cannot audit the books of a company they are financially entangled with. That is not a guideline. That is the foundation. PwC US maintained documented quality control policies specifically designed to protect that independence. Written procedures, defined escalation paths, a dedicated independence office staffed with specialists. On paper, the system functioned. Policies existed. Responsibilities were allocated. But quality control frameworks are only as strong as the culture enforcing them. And cultures bend under pressure. At the center of this story sits a software company. An issuer PwC was engaged to audit. A client whose business PwC was not merely auditing, but actively using for its own internal and client-facing operations. This software issuer was not simply a passive audit subject sitting on PwC's client roster. It was a commercial partner. PwC's teams were using its platform, integrating its tools, building revenue streams on top of it. That dual relationship, auditor and commercial partner simultaneously, is precisely the scenario independence rules are designed to prevent. It creates a conflict so fundamental that regulators have built entire frameworks to prohibit it. Yet within PwC's own governance architecture, the policies in place were not designed to handle this level of complexity. For routine independence questions, the system worked. But this was not a routine situation. The PCAOB, the Public Company Accounting Oversight Board, exists to ensure auditors of public companies meet exactly these standards. Established after the Enron collapse to guard capital markets from auditor failure. PwC knew this regulatory architecture intimately. They had navigated it for decades. They had trained partners on it, written policies around it, and built compliance teams because of it. The rules were not a mystery to them. What happened in 2018 was not ignorance. It was something far more corrosive, a calculated drift, where the pursuit of revenue quietly displaced the protocols that kept the firm legitimate. And no one consulted the Independence Office to stop it. 2018, inside PwC's sprawling network of offices, a calculation is being made, not about audit quality, about money. PwC's tax group began building a business case, a document that would quietly set the entire scandal in motion. The case laid out one central argument. A joint business relationship with the software issuer would generate far more revenue than simply auditing it. The potential was described as worth tens of millions of dollars. Auditing fees suddenly looked like loose change. But here was the problem no one wanted to say out loud. PwC was still auditing the same company. At the same time, to be an independent auditor, you must have no financial stake in the company you're reviewing. That is not a guideline. That is the entire foundation of the profession. Yet by November 2018, PwC had arranged a meeting, two of its own partners walking directly into the issuer's offices. One of those partners was the 2018 audit engagement partner, the person legally responsible for the independence of that very audit. This meeting did not happen by accident. It was arranged at the direction of a national assurance leader inside PwC, someone near the top of the chain. Across the table from these PwC partners sat the issuer's CEO and president, two executives whose company PwC was supposed to be objectively scrutinizing. The topic on the table: joint business relationship opportunities, how PwC and the issuer could profit together. In the world of auditing, this conversation should have triggered an immediate alarm, a mandatory consultation with PwC's own independence office. That call never came, not from the national assurance leader, not from the engagement partner, not from anyone in that room. Numerous PwC leaders and partners knew about the joint business relationship discussions. Each one failed to escalate. PwC did have independence quality control policies. They existed. They were written down. But they contained a critical gap. Those policies did not explicitly mandate consultation with the independence office under these exact circumstances. And so, no one consulted. The logic was brutal in its simplicity. If the rules don't explicitly say you must, then you don't. Financial incentives were reshaping the moral landscape inside PwC. The audit relationship was becoming background noise. Meanwhile, the 2018 audit was still underway. PwC was still signing off as an independent arbiter of the issuer's financial truth. Two identities, one auditor and a conflict growing large enough to swallow both. The PCAOB would later conclude that a reasonable investor could have questioned PwC's independence from the issuer during the 2018 audit. That phrase carries enormous legal and ethical weight. A reasonable investor. That is who this system exists to protect. Not the partners, not the revenue targets. The investor reading a certified financial report and trusting it. That trust had been placed in jeopardy. Not through malice, perhaps, but through something almost more disturbing: indifference. The Independence Office, the one body inside PwC designed to catch exactly this kind of risk, sat uninformed for months. It would not be an internal review that finally forced the issue. It would not be a partner's conscience. It would take a formal document request from the PCAOB's own enforcement division to make PwC look at what it had been doing. Only then, under the spotlight of a regulatory investigation, did PwC finally consult its independence office. Only then did the risk become undeniable. And then the letter arrived. A document request from the PCAOB's Division of Enforcement and Investigations. 3 words that changed everything. For the entire duration of the 2018 audit, throughout every meeting, every business case, every conversation about tens of millions in revenue, PwC had never once consulted its own independence office. Not once. Not a phone call, not an email. The office that existed specifically to protect the firm's integrity had been completely bypassed. The regulators had come asking questions, and it was only then, only under the pressure of a federal investigation, that PwC finally picked up the phone. The consultation that should have happened in early 2018, before any partner set foot in that meeting with the issuer's CEO, finally happened years later, triggered not by conscience, but by subpoena. And what did that belated consultation reveal? Something the firm had spent months refusing to ask itself. A risk, a tangible, documented risk, that a reasonable investor, reading the facts as they stood, could legitimately question whether PwC had been truly independent from the software issuer it was auditing. A reasonable investor. That is the standard, not PwC's internal comfort, not the partner's collective silence. The standard is a person standing outside the room, reading the facts cold. And by that standard, the only standard that matters in capital markets, PwC had a problem. A 2018 audit. A joint business relationship worth tens of millions, and no independence analysis done until investigators forced their hand. This was not a technicality buried in regulatory fine print. This was the core of what an audit firm promises the world: independence, objectivity, the absence of financial entanglement. That promise had been compromised, not by accident, not by a junior associate who didn't know the rules, by senior partners, by a national assurance leader, by people who knew exactly what independence meant. The quality control policies existed. They were on the books, but they contained a fatal gap. They did not mandate consultation with the Independence Office in circumstances exactly like this one. A gap in the world's largest professional services firm. In a policy governing independence, the single most foundational concept in auditing. The gap did not create the problem. The people did. Policies do not consult themselves. Partners chose not to ask. Leaders chose not to require it. And the 2018 audit proceeded without anyone ever stopping to formally answer the most important question in the room. Are we independent? PwC never officially asked, not until the PCAOB forced them to. And when the answer finally came back, it was not reassuring. But the fine, the censure, the headlines, none of that explains the deeper rot. To understand what truly failed at PricewaterhouseCoopers, you have to go back to the choices. The deliberate, conscious choices made by people who knew exactly what the rules were. PwC had independence policies, written, documented, distributed. The framework existed. The guardrails were in place. What failed was something far more human: the will to actually use them. In 2018, PwC's tax group ran the numbers. They built a business case, a formal, structured argument for why the firm should deepen its commercial relationship with the very company it was auditing. And the numbers told a compelling story. The joint business relationship with the software issuer projected revenue in the tens of millions. That figure dwarfed whatever audit fees sat on the other side of the ledger. The math was seductive. The problem was what the math ignored. Auditor independence is not a suggestion. It is the entire foundation upon which public trust in financial markets rests. The moment an auditor has a financial stake in its client's success, the audit itself becomes theater. In November 2018, two PwC partners walked into a meeting with the software issuer's CEO and president. One of those partners was the 2018 audit engagement partner, the very person responsible for signing off on the company's financial statements. They had been sent by a national assurance leader. This was not a rogue meeting. This was not an oversight. This was a directed business development initiative, executed while the audit was still live. And throughout all of it, the business case, the internal approvals, the partner-level meeting, Not a single person picked up the phone to call PwC's Independence Office. The Independence Office existed. Its job was exactly this: to evaluate potential conflicts before they became violations. Numerous PwC leaders and partners knew it existed. They simply chose not to consult it. PwC's own policies were later found to be deficient. They did not explicitly mandate consultation in situations like this one. A gap in the rulebook that conveniently allowed ambition to masquerade as compliance. This is how ethical failures survive inside large institutions, not through dramatic corruption, not through deliberate fraud, but through a culture that treats the absence of an explicit prohibition as permission. At no point did the partners in that November meeting pause to consult authoritative guidance on auditor independence. The conflict between their audit obligations and their business development mission was visible. It was simply not treated as an obstacle. The tens of millions in projected joint business revenue had a gravity of its own. When numbers reach that scale inside a professional services firm, they tend to silence the quieter voice, asking whether the deal should be pursued at all. The PCAOB would later determine that a reasonable investor, someone trusting PwC's audit opinion on that software company, could legitimately question whether PwC had been independent during the 2018 audit. That is not a technicality. That is the audit profession's core promise, broken. Inside PwC, no one had formally named the conflict. No one had escalated it. No one had stopped it. The machine kept moving, audit on one track, business development on the other, both heading toward the same company until they finally collided. This was the moral dilemma at the center of PwC's failure. Not a choice between right and wrong clearly labeled, but the slower, more corrosive choice to never ask the question in the first place. And in auditing, that silence has a cost. When the dust settled, the consequences arrived not with a crash, but with the quiet, bureaucratic certainty of an institution that had finally seen enough. On March 28, 2024, the Public Company Accounting Oversight Board issued a settled disciplinary order against PricewaterhouseCoopers LLP. The order was a censure, the formal language of regulatory disgrace, and attached to it, a civil monetary penalty of $2.75 million. For a firm generating billions in annual revenue, $2.75 million is a rounding error. But the reputational cost, that was something else entirely. Before the order was even signed, PwC had already been removed. They were terminated as the software issuer's auditor before completing the 2018 audit. An audit left unfinished. An engagement severed mid-process. Not by fraud charges, not by criminal indictment, but by a system acknowledging that trust had been fundamentally compromised. The PCAOB's order mandated more than a fine. PwC was required to conduct a comprehensive review of its independence quality control policies, the very systems that had failed so visibly in 2018. Training was also mandated, not just for audit professionals, but for non-audit personnel as well. Every corner of the firm that had operated without independence guardrails was now in scope. And through all of it, PwC admitted nothing. The settlement was reached without the firm admitting or denying the PCAOB's findings, a legal posture as old as corporate accountability itself. The PCAOB did not mince its language in the order. It stated plainly that auditor independence is essential to the trust that investors and the public place in financial statements and capital markets. That trust, the PCAOB argued, is not symbolic. It is the structural foundation on which every audit opinion rests. Strip it away, and the entire edifice becomes suspect. No criminal charges, no broader regulatory overhaul as a direct result. The industry moved on, as it always does, absorbing the penalty, updating the manual, and returning to business. PwC was censured, fined, ordered to reform. And the question that no disciplinary order can answer remains suspended in the air, not just over PwC, but over every firm that has ever chosen revenue over independence and called it judgment. The PCAOB was unambiguous in its conclusion. Auditor independence is not a procedural formality. It is the foundation upon which capital markets are trusted by millions of investors who never set foot inside a boardroom. And yet in 2018, PwC, one of the most powerful audit firms on earth, allowed that foundation to crack. Not through malice, but through something arguably more revealing: indifference to their own rules. Multiple partners, a national assurance leader, meetings with a client's CEO and president about joint business worth tens of millions. And not a single person picked up the phone to call the independence office until a regulator forced their hand. On March 28, 2024, the PCAOB issued its settled disciplinary order, a $275 million civil penalty, a formal censure, mandatory independence policy reviews and firm-wide training. PwC admitted nothing and denied nothing. No admission, no denial. That legal posture, standard in settled regulatory cases, tells its own quiet story about accountability in institutions large enough to absorb a $275 million penalty without restructuring anything fundamental. No sweeping regulatory reform followed, no industry-wide overhaul. The lesson, if there is one, belongs to every audit firm that has ever weighed a business opportunity against an ethical obligation and assumed the scale would balance itself. Auditor independence exists to protect people who trust numbers they will never personally verify. When that trust is treated as negotiable, even once, even quietly, the entire architecture of market confidence becomes a question without a certain answer.